right. Welcome, everybody. We are excited today to have the Money Insights team here with us. We've got Rod, Brennan, and Blake here, and they are going to talk about the investment optimizer. And I'm hosting this one because I'm a client and have been for a while. And Rod and his team have helped me out since the beginning when I started using this strategy too. So I'm a fan of it, and I hope that we get some value for the rest of the community out of the presentation today. I know there's great stuff, and Rod and his team are great with strategy too. So, as with any presentation, we've got the Q&A open. Everybody, I'll make sure as they get started, we're able to post questions in there. So as they're going through their presentation, feel free to put your questions in the Q&A, and then I see that in the chat, we've got the link to more information on the Money Insights page. So you can see that in the chat. And Rod, I think I'm going to have you post that to everyone. So it looks like it came to hosts and panelists.
Okay, yep, I will.
So we'll copy and paste that and throw that in for everybody. Otherwise, I know this is a team presentation. So Rod, with that, you've got your screen showing, and I will hand it over to you for the rest of the presentation, and then we'll open it up to Q&A, but feel free to throw your questions in there as they're going through.
Perfect. Thank you so much, Ryan. Yeah,
Thanks.
we're grateful to be here. And I think, at least I know a lot of people who participated with Left Field Investors. I invest with Left Field, and just grateful for everything you guys are doing, and thankful for the opportunity that we can kind of throw some ideas out there today. And as Ryan mentioned, the strategy we're going to talk about is called the investment optimizer, and it's a way to add another layer of profitability to your investments. And this can be true regardless of what you're currently investing in. I know a lot of people invest in real estate syndications. It might be some kind of note funds or things like that, business, all kinds of different ways that people are doing cool things out there. And what the investment optimizer does is just plugs into that. And again, as it says here, it adds another layer of profitability to that, more return for you than you get by not using it. And as you're listening to this, you may start to think, well, man, it seems like I've seen something like this before. There are others out there who kind of talk about this kind of strategy. They won't use the name investment optimizer. Probably the most common name that you would have heard is maybe like infinite banking. The reason why we call it the investment optimizer is basically to differentiate, because what we're doing with it is very hyper-focused toward people like yourselves who are investing in these types of things. So we're not going to talk about using it in other ways. We are hyper-focused on using it to make, to again, add that additional layer of profitability. So that's really our focus. And we've been doing it for years and years, have more than 1,000 clients that we help and work with on an ongoing basis in doing this. And so it really is our passion. And that's why we want to share it with you all today. So with that said, what I'm going to do is hand over to Blake the baton and let him jump into the first topic here.
Yeah, thanks, Rod. So I'll kind of just give a high level overview of what the strategy is, kind of where it fits alongside your investing. So if you're someone who's investing in the things Rod mentioned, business, syndication, notes, ATM funds, whatever it may be, a lot of times, one of the issues that people have before they start utilizing this strategy is they may love what they're doing on the investing side. You're out there doing some cool things, good returns, all that kind of stuff. But your money in between deals just isn't doing a whole lot for you, right? Especially if you're saving up, significant funds before you deploy them into these investments. Just the dollars in checking savings accounts where you're storing it. Obviously, you have the safety liquidity there, but there's no growth, no tax advantages, things like that. So really, at the end of the day, the investment optimizer, the goal of this is just to give you a better place to be storing your capital in between investment deals, and to do it in conjunction with what you're already doing on the investment side. So in an ideal world, what would we be able to do with our capital in between investment deals? Well, of course, we want that liquidity, right? We need access to funds to be able to deploy, and we want safety. So we don't want to be taking any more risk. But as I mentioned, growth would be nice, right? As opposed to, I know, there are some accounts earning a couple percent now, but we're able to, with this strategy, earn significantly more than that. We'll get into how that works. And then also we have tax advantages with this strategy. So our money is able to grow tax-free. We're able to access it tax-free. And then some tax advantages on the back end as well. But then really one of the cool parts about this strategy is you're not choosing between the investment optimizer and what you're doing on the investment side. Because of how we're able to access funds, you're able to stack returns. So you have your money working for you in this strategy. And because of how we're able to access funds, which we'll get into here in the webinar, you're able to create multiple returns. So both in the strategy and in the investing that you're doing, having your money work for you in two places. And we'll jump into how that works and the type of numbers that we're able to create there. So really at the end of the day, we're just looking at options of what is the best place for your opportunity fund to deploy capital into the investing that you're already doing, right? We touched on a lot of people are using savings or money market accounts. What we're just going to go through here is really why the investment optimizer and the strategy is the best place to be flowing money in and out of your deals from. So to kind of jump into a case study, again, going to keep it high level, but just do a person A, person B. You know, as Rod mentioned, we have a lot of people, you know, over 1,000 people utilizing this this concept, and I want to show just high level why it makes sense to plug into your investing. So, Rod, if you want to go to the next slide here, but yeah, we have investor A, right? So he's building up money, probably like most people who aren't utilizing this strategy in their opportunity fund, which just by default ends up being a savings account, right? He's got the ability to fund deals that are going to produce a 16.5% rate of return, which is great. Now, investor B, this gal here, she's really just adding one step. She's flowing the money into the investment optimizer, and then we'll get into exactly how this works, but using the investment optimizer to fund the exact same deals. And then she's turning that 16.5% yield into a 20.8% yield, right? So that's what Rod was talking about, adding a layer of profitability to your investing. So what are we talking about here? This could be any investments. You can plug in whatever you're doing currently in the investing. A lot of clients that we have participated in an ATM fund. Okay, so we're just picking one out there. So in the pro forma of this ATM fund, you know, it's calling for an $104,000 initial investment. We don't take into any depreciation. The net cash flow from this deal would be $183,000 over the life of the deal, with an IRR of 16.5%. Now, with depreciation, you know, we're able to create significantly higher returns, $224K with an IRR of 30.7. So that's just using the typical savings account to go out and invest. Now, when we flow into the investment optimizer, using that to fund this same deal, the net cash flow we're able to generate, you know, goes from 183 to 215, or that IRR that we talked about of 16.5. We're able to increase that. This is investor B who's using the strategy. That goes up to 20.8%. And then when we include depreciation, we're going from 30 to 30.8, or excuse me, 38.5. So while, you know, the numbers may not be jumping off the page at you right away of, oh, this strategy is all that much better, when you use it in conjunction with what you're doing, you know, we're able to create pretty significant jumps in terms of an IRR.
And if I can just jump in real quickly, I love this screen because it takes that 16.5%, like the investment itself is pretty cool, right? Like you put some money in, you get this cash flow back out. In this case, it's over the course of 7 years. 16.5% isn't bad, especially right now, right? But then by utilizing depreciation, additional tax planning that again, I'm sure all of you are doing as you're out there investing, trying to be as efficient as possible with the tax planning, then you turn the 16.5 into 30.7. And then of course, by adding the investment optimizer, now that 16.5 all of a sudden is 38.5. So it just emphasizes this presentation isn't as much about the other parts of why we love alternative investing. But when you include them all together and then add this as an additional piece, it just makes it amazing.
All right, let's jump into the type of account that we're using. And again, Rod mentioned term infinite banking. What we're doing with the investment optimizer is using what we call, it's long definition here, but max overfunded dividend paying whole life insurance contract. So for those of you who aren't familiar with this, you may have a positive or negative kind of connotation when it comes to whole life insurance. To be very clear, we're utilizing life insurance that's designed, as Rod said, purely for the investment and to use in conjunction with your investing. So we're building these policies with a very high cash value and limiting the costs or the death benefit really as much as possible. So these contracts that we're putting into place for this strategy are really designed just to maximize the investor component. So when we set it up this way, what we're able to do is generate, after all costs, a net roughly 5, sometimes can be higher than 5% return. Again, after all costs are factored in on the growth of what's called cash value, or really the investor component, what we're using to fund deals. So we're able to generate that 5% return after all costs, but then additionally, we're able to do that on a tax-free basis as well. So that can, when you factor in taxes, can add to that. Now, of course, with this strategy, as I mentioned, we don't want to be taking any more risk, right? So because we're using whole life insurance, I won't get into too much of that, but there's some guarantees, and we know without a shadow of a doubt that our cash value is going to be growing each and every year. So by utilizing this, you're not adding any risk into your strategy. It's very predictable how these grow. Brennan will get into that a little more here, but we're not taking any more risk. Now, of course, we also need the funds to be liquid, right? So depending on what you heard, you might have heard, oh, it takes a long time to build cash value. Well, the way that we're building these policies, you're going to have access to your cash really within 30 days. Sometimes we can even do it quicker than that. So as you fund this strategy, those funds are available to you within a couple weeks. It's liquid that you can tap into. And we routinely have clients who will fund this strategy and then turn around right away to go out and invest in the things that they were already planning on doing. Fifth, we have a death benefit. Now, the reason that we're setting up the strategy is not for the death benefit. It's just kind of something that comes along. You don't have to pay for it in any other way. And even though we're trying to minimize it, just as you use it in conjunction with your investing, you will find that you're building up 7-8 figures worth of benefit that could be passed on to your heirs or whoever you wanted. And then really the sixth part is what we're talking about in order to create value in multiple places at the same time. The way that we're doing that is through a loan provision. So when you fund this account, you're able to earn all these benefits here. And then as opposed to taking money out of the account to go invest, what we're able to do is borrow against it. Brennan, I'll let you talk more about that. But utilizing this loan provision is really kind of the secret sauce of the strategy and allows us to have our money working for us in two places at once.
All
Brennan,
right, awesome.
Yeah, go for it.
Yeah, thank you. So let's jump into a little bit more of the mechanics of this max overfunded dividend paying whole life insurance policy and how it actually works. So first, we're going to funnel money into the investment optimizer, and I want to cover how that grows. So how this money is growing inside of this account itself, and it's going to grow in two different ways. The first is the guaranteed interest. And depending on the insurance company, they all have different guarantees, but it's going to be anywhere from 2% up to about 3.75% is what the guaranteed interest is going to be. And then because we're using mutual insurance companies, the policyholders are owners of the company. And so when the insurance companies profit that year, we get a dividend. So the dividends aren't guaranteed. However, we only work with insurance companies that have been around for 100+ years. And so for that dividend to not be there, that would be pretty odd or atypical. And so the guaranteed interest plus that dividend is how we're able to get up to that 5% net return inside the policy. So let's talk a little bit more about the mechanics of how this works with the flow of the cash. So the money goes into the opportunity fund. We're not going to take money from that specific policy, but because we have this policy, it allows us to have access to this much bigger bucket of money, which is the general account of the insurance company. And what we're going to do is we're going to take a loan from the general account using our opportunity fund as the collateral for that loan. And so we take this loan from the insurance company, we then take that and put that into a cash flowing investment. And then we're going to take that cash flow, not because we have to, but because we want to, we're going to funnel those dollars back into to repay that loan so that we can replenish our opportunity fund so that we're ready again to fund another deal. And we're just going to repeat that process over and over again. And the really great thing is this little separator here is showing that we have those dollars working for us outside in that cash flowing investment. And during that time, those dollars are still sitting inside of our opportunity fund, continuing to earn compounding interest. And so that's how we're able to earn interest in two different places at the same time. Is our opportunity fund continues to earn the compounding interest, plus we're able to use those dollars with the loan provision to go out and generate cash flowing assets outside of the opportunity fund.
And one thing I think is really helpful to plug in here, because we're often asked, okay, well, great. So I've taken the loan, I've invested it. Now I have that cash flow going back. Well, who decides how I have to pay that loan back, right? Is the insurance company in this case, because I'm using the general account, are they going to tell me, hey, here's your set payment schedule, or you have to pay this back? And the answer is no. And it's because the collateral is the money that's sitting in that account that's with them, right? So because of that, they give us ultimate flexibility. And when I say that, what I mean is you get to decide how you want to pay it back. And really that what makes the most sense to me and what I do with my investing is the return I'm getting from my investments, I just flow all that back towards it. As Brendan said, I'm paying down the loan, but strategically the way I think of it is I'm replenishing that opportunity fund so that I can go back out and do it again. Again, this is the same thing that you're doing currently, or that we find people doing, where they have that flow and they're all flowing it through this savings account, right? Build it up, go out and invest, create cash flow, flow it back to the savings account, build it up and go do it again, right? So we're just replacing the vehicle. Instead of using the savings account, we're using this highly overfunded, max overfunded policy as the opportunity fund. And then, but we still have all of that same flexibility in terms of how we flow the money back. It's completely up to us. And that I think is really one of the cool things, because it just gives us a lot of flexibility.
Yeah. And I thank you for mentioning that, because a lot of our clients, invest in all sorts of different cash flowing assets. It could be a syndication, it could be self-storage, ATM funds, businesses. You never know how that cash flow is going to come back, whether it's going to be an even thing, cash flow every single month, distribution once a year, or a liquidity event, in 4 or 5 years. And so there's no penalty to not paying that loan every single year if you don't want to. Now, what I'm going to show you is what it looks like when we do pay that loan every single year, but you have the flexibility to funnel dollars back into the policy whenever and however you'd like to. So let's talk a little bit more about the leverage. So that's what we're doing, is using leverage with the investment optimizer. We're generating this tax-free growth inside of our policy. We're creating value in multiple places at the same time by using the loan provision. And then a very key part of this is the difference between paying simple interest on the loan and earning compounding interest in our policy. And so what we've prepared for you is an example of that. And first, I just want to show this graph showing compounding interest, and then showing the simple interest on the other end on the right-hand side. And you'll notice that the simple interest is on a decreasing value. So we're not just continuing to pay the simple interest every single year, but we're actually paying down that simple interest. And you're going to see, in this next slide, a very stark difference between the two. So again, I'm going to show equal payments going in over 20 years. We're showing this, $100,000 loan. We're paying back $8,000 a year, interest charged over that 20 years. So we're going to pay $60,000 in interest on this simple interest loan. On the other end, we have our $100,000 that's still sitting in our account, acting as that collateral, but it's earning compounding interest. And at the end of the same 20 years, we earn a total of $165,000 of interest. So we earned $165,000 in compounding interest. We paid $60,000 in simple interest. And so by utilizing the investment optimizer, we're able to add an additional $105,000 to our portfolio just by using the policy.
And there are a lot of keys and reasons why we want to talk through this piece of it and the specific arbitrage. One of them is because in the investment bank or the infinite banking world, they often talk about trying to create an arbitrage between the interest rate that you're paying versus the interest rate that you're earning. And what we want to show here is, because we're using loans for investing, creating value out there, it doesn't matter. Like in that example, we were earning 5% and we were paying 5%. And even at that same rate, we still create this $105,000 difference because of the difference between paying compound and earning simple. And I only bring that up because if you have had exposure to some of these other concepts before, and you hear people really emphasizing this idea of creating an arbitrage between interest rates, that's not necessary when you're using it in the way we're talking about, right? When I'm investing, I'm creating that value out there. It's money I would be flowing into my opportunity fund anyway. And so as I'm doing that, I'm covering that at simple interest while the account keeps growing. And that this is where my arbitrage comes from. I think it's a really key piece to understand on this. All right, so a little bit ago, Blake showed a investor A, investor B concept, where the difference between the return that they were able to get, the IRR they were able to produce, was very different. The next thing we want to do is actually take these principles, all the things we've been talking about, and apply it to something that's more over time. So in this example, what we're going to show is somebody who, for the next 5 years, is setting aside $100,000 a year that they're capitalizing, right? They're setting aside in their opportunity fund that they're going to be using for their investing. And to be clear, we're not waiting 5 years before we start investing. Immediately in year one, we're going to start with an investment into a real estate syndication, and then turn that cash flow back towards the opportunity fund, continue to build it up, and continue to fund the $100,000 a year for the next 4 years. And then beginning in year 5 and every 5 years after that, we're going to be using the money that we've built up inside of that opportunity fund to go out and buy additional real estate, cash flowing assets. And when we do so, we're going to have the 20% down be what's coming from that opportunity fund, and then get an 80% loan from a traditional lender for the rest of it. And our assumption on this is a 15% cash flow, net cash flow from the investment, with a 5% appreciation on the properties. And on that point, I just want to be really clear on this, that the specific return on this isn't necessarily as important as the principle that we're going to show side by side. Hey, investment optimizer versus savings account. Because I'll have some people who will say, wow, man, I only wish I could get 15% on my investments. And then I have other people who say, I wouldn't do a deal if I only got 15%, right? If that was my expectation. And then similarly on the appreciation on the property. So anyway, so I just don't want people to get hung up on the specific numbers, but what we're going to do is show apples to apples. You use equal cash flow on the investment optimizer side as we are showing on the savings account side. So then you can see ultimately the difference over time. All right, so let's jump in here, and a lot of numbers to look at on the screen, but let me just kind of talk through it really quickly. So on the left-hand side, you see the investment optimizer. On the right-hand side, the savings account. In year one, we have the initial 100,000 that goes in, and as you would expect, your 100,000 on the right-hand side is 100,000 going into the investment, right? Into that syndication we mentioned. On the left-hand side, there are costs to setting up these insurance policies. We recognize that, we show it, we don't hide that, and we think it's important in this type of a comparison to recognize that there are real costs that lead to opportunity costs, and are we able to overcome those? And if so, what's a realistic expectation on this? So what this shows is initially, on the investment optimizer side, of the 100,000, you could expect about 74,000 of it available to go into the syndication. Okay. But then, like I said, we're continuing to put the 100,000 a year away. We are capturing that cash flow coming off of the syndication, flowing that back into the plan, so that beginning of year 5, we are able to go out and buy a piece of property. And again, with 20% down, 80% of that financed, we buy the property, create more cash flow coming off of it, capturing that cash flow back into the system. By this point, we're no longer putting additional money outside of the plan. That 100,000 a year for 5 years is all of the outside money that's gone into this. From here forward, all of the money flowing into it is coming from what we're actually creating inside of these investments. But again, we recapture it, we go back out and invest every 5 years. And we get to a place where now we're buying larger properties with the investment optimizer for the reasons that Blake talked about earlier. We're creating that growth. That growth is tax-free. When we access that and use it as the down payment, and then borrow the other 80%, then we're able to just get a lot larger properties with the kind of the gap growing as time goes on. so that in the long run, we get to a place where at the end of those 20 years, we have produced a difference, an additional value through the investment optimizer of a little over 2 million compared to doing the same investing with the same properties on the right-hand side with the savings account. So I think it's important. Earlier on, we've focused on the additional IRR we're able to create. And then as that turns into real dollars and cents over the course of time, then you can see that it's not a small difference, right? Now, am I saying that the investment optimizer is doing all the work? Well, no, the real estate is doing most of the work, right? You turn that 500,000 into, even on the right-hand side, into basically $20 million worth of value. But if you could, instead of having 20, you could have 22 million just by implementing this opportunity fund as an alternative to the savings account, then you just have more value there as a result. Okay. All right. So with that, a really natural next question that we get from people is, okay, great. I've built up the additional value, the 2 million or whatever it is, over the course of 20 years, 15 years, 30 years, whatever the time frame is. And then what, right? Okay, so now it's the additional value is now sitting in this insurance company. Do I have to die in order for anyone to get any value? Is this just going to be, additional going to my kids? And the answer is no, because what happens with these policies, for the same reason as we were able to access it for our investing, we can access it for anything else. So in this case, what we're saying is what we call phase two. Once you get to a place where you're slowing down in your investing, you're now living off of the cash flows that you've generated from all this alternative investing that you've done. In addition to that, we can use tax-free income from the policy to supplement that. And there's no IRS restrictions. Think of it basically like a Roth. In other words, you put in after-tax dollars into the plan to begin with. It all grew tax deferred. In other words, you weren't getting a 1099 at the end of each year to reflect the growth. And then when you're now accessing it to use it, shall we say permanently, instead of loans to invest and flow back in, you're not planning to pay this back, but it keeps coming out income tax free, and so it's again getting the same kind of benefit as a Roth, but without the same IRS restrictions. You don't have to wait till 59 and a half before you start accessing the growth in it, etc. So it's the value we're creating here continues to create value even beyond the time frame where you are doing the actual investing. Okay, so let me, with all of that said, let's hit on our key takeaways that we just want to make sure everybody walks away with. So number one, we're creating an added layer of profitability for investors. And I know we've said this, but regardless of what you're investing in currently, you continue to invest in that. This doesn't replace that. It just works in conjunction with that to create that added layer. Secondly, we're doing it tax-free. And I don't know if we can say this too many times because there aren't a lot of places you can go to get tax-free growth, but this is one of them. Third, it's very safe, it's predictable, which is really important. When I loan against it and go out and make my investing, I'm taking on risk when I do that, right? Well, I don't want there to also be risk in my opportunity fund that's sitting back here. I want it to be growing in a very predictable and safe way. Fourth, we haven't touched on this yet, but there's actually some creditor protection that comes naturally with life insurance. In other words, the money I have sitting in in the cash value of my policy is not accessible. If I'm sued or whatever, they can't go in and grab it. It differs a little bit from state to state. So make sure if this is important to you and we're having a conversation, we want to look at that specifically with your state. But it's a huge benefit. And then the fifth, we talked about the tax-free retirement income of phase two. And let's not forget, I didn't include it on the slide, but phase three is the actual death benefit. When that pays out, it can create some additional liquidity and benefit for your heirs. And so that can be a huge portion to this. As Blake mentioned, it's kind of ancillary, even though we're using life insurance, it's not the primary thing we're thinking about now. But when you fast forward and you think about, where you'll be at that point in time, you're passing on the estate and all the cool things that you've done. to your heirs, then this becomes a very efficient way to pay to pass along cash to go along with that. If you have a business, if you have real estate, you don't want the your kids in a pinch because they need cash to whatever, keep the business going, to pay taxes on the real estate, whatever it might be. With the life insurance, you have cash that flows with the rest of the estate and whatever assets are inside of that. So that's a big deal as well. Okay, so with that said, that is what we had prepared. And we will jump into our questions here in a second, but I put the URL in our the chat as well, but here it is. Go to moneyinsightsgroup.com/LFI, Left Field Investors LFI, to check out additional information about us. And also if you'd be interested in, scheduling an opportunity to sit down with us, there's a spot there where you can grab a spot on our calendar.
All right. Thanks, guys. Feel free to throw some questions in the chat. I see we've got one that we'll get to. So feel free to plug your questions into the Q&A. I'll make sure again that everybody's able to put them in there. So we'll start. Daniel's asking, what about pre-existing health conditions?
Yeah, I'm happy to
go for it, Blake. You
okay.
got it.
So that's a question that gets asked all the time. Okay, well, based on my health status, would I be able to qualify? People also ask about this for their age. I also noticed that regardless of what age people are, they ask, am I too old for this? So a couple options. One, we can always look at you going through underwriting and seeing what you can get. That's one option. The second, which is probably pretty popular, is you actually can own a policy on anyone that you have what they call an insurable interest on. So that could be someone like a spouse, your children, a business partner, anyone that you could make a case that you would have a financial loss if they were to pass away. You can use them as the insured and you be the owner on the policy. I was speaking with someone this morning in this exact same position where he had some health history, and so we were using his wife as the insured. So she's the actual insured life, but he's the owner on it. So once she goes and gets that approved for the insurance, he's the one funding the policy. He has access to the cash value. It's just that the death benefit wouldn't be created when he passes away, but rather when his wife. So if you have health conditions or you're older and you're saying, hey, could this work for me? Absolutely. As long as, you have someone else in your life that we could make a case for, that's an option. We could also look at you as well. Good question, though.
Great. There's another question that comes in. It kind of tags onto that too. So feel free to add to it what you think makes sense. But is age a factor? I'm 66. Would this make sense?
Yeah,
Okay.
I'll go. Yeah, go for it, Rod.
Okay, so it's a great question, and the answer is that it isn't so much that age makes the difference, because for a 66-year-old, we can still build a really good policy that grows the cash value. Really, the bigger factor is how long are you planning to be investing, right? Because put it this way, if someone said, "Hey, Rod, I am investing now. I'll be ready to start cashing this thing out in the next 3 or 4 years," I would say we probably just don't have enough time to build it up. As you saw in the example with those initial costs, we need a little bit of time to start creating this cash flow to start overcoming those initial costs. Now, if someone said, "Well, I'm going to be investing for the next 5 years, and then I'll have cash flows coming from my investments, and I'll be living off of those, but I want to tap into this." So there actually are situations where it could make sense, even as early as 5 years later. So that's the real answer to the question, whether you're 66 or 56 or 46, but you're only planning to be in the game for another few years, then it may not make any sense. But if it's more than that, if it's 5 or more years, then I think we can make a good case for it. At least it would make sense to look at the numbers and see if, what that looks like in your specific situation.
I might add one point to that as well. Sometimes when you hear about insurance, obviously like term insurance or more standard types of insurance, the premiums are going to be much higher the older you get. That being said, the way that we're designing the policies, the insurance component is basically as small as we can make it. And so that's where Rod was saying, we can still design a great policy for a 66-year-old because of how it's designed, and a lot of the cash going into the policies not going towards the insurance cost. That's minimized as much as possible. But yeah, that's why we can still make it work. So again, we're happy to run numbers and show you what it would look like regardless.
Okay, thanks guys. Next question, and Rod, you kind of answered this a little bit as far as 5 years, but the question on this one is, what's the minimum we can invest per year for the next 5 years? And I know all of these are conditional or situational answers, but best you can on this one.
Yeah, the good news on this one is that there really is not a minimum. In other words, for somebody who says, hey, I'm setting aside X amount of dollars for my investing, we can build a plan around that, whether it's 10 grand, we have clients doing that, whether it's 100, whether it's $1 million. It's really more about us being able to optimize the plan. Now, if you're saying I'm setting aside $100 a month and I'm 50 years old, then we might be getting into territory where we're not really able to optimize that policy. But for anyone who's setting aside, again, any 10 grand or more for that investing, then we can absolutely build a plan around you. And we're going to custom build it to the individual and those specific dollars that they have that they'll be flowing into their plans. And I'll also say this too, there's a lot of flexibility with it. We create what we call a funding range. So in the example I used where we were showing 100,000 a year going in, that person could be doing anywhere between about 25 as a minimum up to 100,000 a year as a max. So we can be pretty creative in the way that we build it, again, around the individual and what they're doing and what they're anticipating in terms of their investing, all those things.
Great. Yeah, and I think that's a really important point to add to that question too, Rod, is the flexibility in the payment range too. I know that when we worked together, that was something that we talked about too. So that's a real key thing that I think you brought up there, is the flexibility in the premium range.
Yeah, absolutely. And maybe just as I'm kind of thinking through, there are a lot of different scenarios we see. So the money that's flowing in there can be built around the individual's income. So let's say I have a regular job, I'm working hard, but then I'm also investing in these other places, and I'm just carving off a portion of my income, then obviously that fits in. If I already am investing and I have cash flows coming to me, and those are cash flows that I want to flow into additional deals, I want to capture that as well. If I have investments where I'm having liquidity events coming back, then we would want to capture that. And maybe to say it a different way, personally, this is the way I approach it. Ideally, I want to be setting aside every dollar that's going into my investments into the plan first to optimize those dollars, create that additional profitability on as many dollars as possible. And, it doesn't always work, right? Especially when we have these liquidity events that are a one-time thing and whatnot, the funding range does allow us to be somewhat creative with those situations. But at the end of the day, that's kind of what we're thinking about when we talk about customizing the plan. Those are the kinds of conversations we're having with people in the money they're setting aside, money coming off investments, et cetera, to kind of create a plan.
Great. Any more questions? Feel free to throw them in the chat. A couple things I wanted to note too, again, as Robin pointed out, the link to the landing page for more information is on this last slide and also in the chat. We'll also see Rod and his team out at the meetup in October. So coming up, I would encourage you to reach out if you have questions in the meantime, but we'll also be able to see them in person and listen to some content there at the meetup.
Yeah, we're excited for that as well.
Yeah. Yep. So if you're going to the meetup, if you're not going to the meetup, you can still sign up. There's still room out there. So Rod, maybe just a couple general questions here. If someone has a policy, if they have a policy, what would make them want to look into something like this? Any kind of policy that they might have. If I already have life insurance, what would make me look into something different?
Yeah, it's a great question. And to begin with, it doesn't hurt to get a second opinion. Or in other words, there are a lot of life insurance companies out there, a lot of products. And our goal, like when we set up a policy every time, is to make it optimized to grow the cash value. And if there's someone who has an existing policy, that may or may not have been the approach when it was set up. And so, we're more than happy to take a look at it and give an honest opinion, because for us, because of the way that we do our business, we keep tabs on all the different companies. In other words, Brendan mentioned earlier, we're specific to mutual companies because they pay dividends. Okay, yeah, we're always going to use a mutual company. And then secondly, we only want to work with companies who've been around a long time, consistent paying a dividend, A-rated with the independent rating agencies. So that creates a list of maybe 10 or 12 of these mutual companies. And then what we do is we compare all of the products across those companies so that at all times we're offering the product that gives people the best long-term growth on their account to, again, subsidize or create this additional layer of profitability. And so, it isn't so easy or obvious to do. Even in insurance agents who've been in the business for a long, long time, if you went to them and said, hey, Rod said I want a max overfunded dividend paying life insurance policy, can you build that for me? Again, they'll probably all say yes, but whether or not it actually, it is truly optimized. We have people tell us, hey, that this was supposed to be optimized, and then, we'll look at it, maybe it isn't, but maybe it is, right? And we'll just be straight up with you and let you know if that's the case.
Yeah, and I appreciate you going into detail on that, because it does have to be structured the right way to truly be optimized. If you listen to Jim, who used to sell life insurance as well, he said he would fire the guy that wrote his first two policies, and those were Jim himself, because he did not know what he was doing at the time, and his policies weren't optimized. So does have to be someone who knows exactly what you're trying to accomplish with that policy. Kevin had a question here. Is your business based on mainly upon selling life insurance, or do you have, or do you also advise on specific investments?
Yeah, Brennan, do you want to take that one?
Yeah, absolutely. So we have a lot of community partners that are similar to Left Field, and a lot of really great resources for our clients that they're able to tap into. We specifically focus on the life insurance side of things, not only the investment optimizer, but we have a handful of other strategies that are really great tools to utilize in somebody's portfolio. And so I would say that we mainly focus on permanent life insurance strategies, but we also have a large community that clients are able to tap into that provide quite a bit of value as well.
One thing I'll add to that too is that when we have someone who works with us to build an investment optimizer policy, it's a long-term relationship. In other words, as important as it is for us, what we were talking about, to build the right kind of policy structured in the right way, that's not where it ends, right? And so we're literally having conversations on a regular basis. Ryan, you and I meet 2 or 3 times a year at a minimum, as we just walk through kind of what your policies are, what they're doing, but then also as you're out investing and you're using them for the strategy. And that's exactly what we're doing with all of our clients. So it's a strategy, not just a product, I guess, is the kind of the point there.
Yeah, great point, Rod. And we've got multiple policies set up with you guys, and we have conversations. It's not a one and done deal. We have conversations about what it's doing, how it's doing, if it's accomplishing it, and tracking progress too. So very well said there. Okay, James is asking, how do you make your money on these products?
I can jump on that because it is a good question. Obviously, people bring that up. So one of the nice parts about what we're doing is, when we show you an illustration for any different company, as you set that up, those companies are paying us directly. Nothing's coming from you to us. So everything that we're doing is net of all costs. So that would include insurance costs, death benefit, what the company essentially, their fees for getting the policies set up, and admin, what we're getting paid. So anything that you would see from us would be net of all costs. So again, we're contracted with basically all the companies that you would want to consider. There's thousands of life insurance companies, 10 to 12 probably would actually have products that you could use for this strategy. So we can use all of those. We're always running the different options, as Rod mentioned, both different products and how you design those. And then where we get paid is the insurance companies pay us directly, essentially, for getting the policy set up. So everything that you would see from us would be net of all costs. You don't pay us a retainer or anything like that. We get paid from those companies directly.
Okay. And he's just clarifying here. So you're essentially a broker.
Yeah, at the end of the day, I would say that that's accurate. Again, we're as Rod said, we're meeting with clients regularly. So what maybe makes us a little different from some people is because this is such an ongoing process utilizing these loans. We have a whole team set up for that. But yeah, at the end of the day, we would be a broker for different insurance companies.
And I think that's important because we're not tied to just any one company, right? A lot of you go down the street and you see a lot of the insurance agents there, and they're hanging up, they're representing a specific insurance company. When you ask them for products, they're bringing to the table only those products, and we feel like it's very important that we have that kind of independence to go and use the companies and ultimately the products that are getting us the result that we want, right? Not just whatever the company offers that we're in.
Okay. Next question. If you invest 20,000 in year one for 5 years, how much would you be able to invest from the cash in the opportunity fund and in 30 days?
Yeah. So that initial amount that we set in. So we'll go back to the example that we showed. I'll actually jump back to that screen because it'll all be pretty linear. So in that first year, 100,000 goes in. We have roughly 77,000 in the cash value. We access 74. As a percentage, that would be pretty true. So if you're putting 20,000 in, then you might have access to roughly 15,000 or something after 30 days as an initial. And the costs are higher in that first year. So in year two, you put the next 20 in, and you're going to have 85 to 88% of that available in that second year. And then in year three, the costs go down again. Of the 20 you put in, you're going to have roughly 20 available to go out and use for the investing. So then two things are happening. Number one, the costs are going down, especially off of those first couple of years where the costs are higher. And then the second thing that's happening is we're starting to see some of that compounding growth take hold of what's in the cash value and what is growing there with the guaranteed interest and the dividend. And so those two things together make it much more efficient as time goes on, as you continue to put money in.
Okay. A couple new questions coming in. Sean is asking that of, has this strategy ever not worked according to the projections?
I can jump in on that. So according to projections, no, that's the key part to this strategy on whole life insurance, especially when it's structured the correct way. In fact, I would maybe say that the only time that something doesn't work out according to projections is due to the policy being structured incorrectly or not for cash value. So when you structure a policy in the correct way, meaning the max overfunded dividend paying whole life insurance policies, those are very guaranteed, almost right on the dot every single year as far as a projection goes. Now, if you're going into different insurance products, something like an index universal life policy, that could have more variability. And that you could see something where a projection shows one thing and the actual reality of it shows different, again, largely based on how that policy is structured. So according to the way that we structure our policies, utilizing whole life insurance, no, very guaranteed. And we just know exactly what's going to happen. If it's not structured the correct way, those kind of bets are off.
Yeah, and the one part that does vary from year to year is the dividend portion. So that you have the guaranteed interest, and that's contractually set. That doesn't change. It is what it's going to be for the life of the policy. The dividend will fluctuate from year to year, and there are a few factors to that. Probably the biggest factor is kind of reflective of what's happening with interest rates. So when we were talking earlier about expecting a net 5% return, we said 5+ because again, that variation may make a difference on that. But the cool thing is for where we are right now and the way we're projecting things as we speak, because interest rates have been low, our projections are historically showing a lower return. So depending on the insurance company, somewhere between 5 and 6% is what the policies are earning when you include the guaranteed interest plus the dividend. So, and then that nets out at the 5%. As interest rates are going up, we anticipate moving forward that we'll see higher dividends as a result as well. So when you're looking at a specific projection today, and then you say, okay, well, in 10 years, 20 years, how likely am I to see the exact same numbers in my account as what I'm seeing here? I would say it's not likely that they'll be exact. But to Brendan's point, just the consistency and the predictability of these companies and what they're doing, if it's different up or down, it's going to be different by a very small percentage.
And I think a couple important points that you made too is the product itself. So there are different products out there that that will have different results. And then really want to emphasize too that the investing that you do with your investment optimizer account, that is totally independent of how the policy itself performs. So the investing that you do is a totally separate deal, but the way the policy performs, I think, is where you were asking the question and how that performs. So
yeah, that's a great point. And I'll also say too, with this slide that we have here and the side by side that we did put together, we wanted to keep it like represent kind of really what someone could expect, but also keep it simple. So are most people who are listening to this buying a syndication that cash flows for 20 years? Probably not. Are they investing in a piece of property that they purchase and again, just cash flow without refining or doing anything along the way? Probably not. There are additional things that you're doing probably to improve your investments beyond what we showed here. But again, just to keep it simple, we weren't assuming all of those things. So.
Okay, a couple more questions. I know Mass Mutual issued some guidance to brokers regarding infinite banking policies. Are you finding the mutual companies are refusing to issue infinite banking policies?
Yeah, I can touch on that. And I'm familiar with Kevin, what you're talking about there with Mass Mutual. So, and that might be part of why Rod said it, we believe that's really important to represent a bunch of different companies. So to answer your question specifically, Mass Mutual would be one of those companies that has kind of said, hey, we don't really like this business for various reasons. However, there's other companies who, in my opinion, have gone the other way and said, yeah, we understand what you're doing here, why people are, funding the policies this way and taking loans, and frankly, love that and like that business and have set up their company and their products to be able to do that well. So yes, Mass Mutual would be one that might not love that as much, but that being said, there's a couple other companies who really like that business that we work with and have good process set up to be able to facilitate loans and loan repayments. They have great online portals in terms of where you can go see your values, just like you would a bank account, move money in between. Then also we have someone on our team who handles that for our clients full time. So our goal is that you don't ever have to reach out to the insurance company. You don't have to deal with them. You can, if you want to just avoid us. That being said, we have someone, pretty dedicated to being able to help facilitate those loans for you and loan repayments. Because again, we have, over 1,000 clients who are actively utilizing this strategy with their investing. So that's something that we kind of do on the back end.
And I'll clarify really quickly, if you're someone who sees that or hears that and you're saying, well, I have a Mass Mutual policy and I'm, can I keep using it? And the answer is absolutely.
That's a good one.
They're not restricting your ability to take loans. If you're already kind of midstream with that, keep going, keep doing it. That directive from the company was more directed toward people like us saying, hey, if you're out doing this type of business, we're not interested right now.
All right. Last question we have in here for now is Sean was kind of elaborating on his previous question. Are the returns based on market, equity, or debt returns? So a little bit to that caveat that I had thrown out there, but I'll let you guys answer.
And I kind of was talking about this earlier, so I'll touch on this one. And the answer is that it's the guaranteed interest and the dividend, right? So there's no link to what's happening in the stock market, or even necessarily specifically to bond rates. But what does dictate the dividend? There's basically three factors. Number one is the profitability of the company, as you'd expect, as dividend for any company. Number two, what's unique to the insurance company is because it is life insurance, the kind of, I call it the mortality experience, or the number of insurance claims that they're paying out. If there was a large amount of people who all passed away in a short period of time, then that would impact the dividend, or could impact the dividend. And then the third factor, which is the most impactful, is the kind of return that the insurance company is getting on their investments. And they invest primarily in bonds, notes, those kinds of things that are sensitive to interest rates. So in the answer to your question is that as a policy holder, I'm not investing, or the return I'm getting is not directly reflected by equities or the debt markets or things like that. Indirectly, more so to the debt markets, because that's where the insurance company gets its returns.
All right. We're coming up on the hour here, but if anybody has any more questions, feel free to throw them in. Anything you guys want to add before we wrap up?
We just appreciate you having us on. I think this has been a really good experience, and I appreciate the questions, the engagement from people.
Yeah, likewise, Sean. Sean says thank you in the Q&A. So thank everybody on here. So everybody who joined the call or watches the recording, hope you find value in this. And Rod, Brennan, and Blake, we appreciate you and your time, your insight, and your help on the call today. And hope you have a great day, and we'll get the recording out shortly. So thanks, everybody. Have a good one.
Thanks, Rick.
You bet. Bye.